Hi, my name is Alexander William Elliott. I'm CEO of AW Elliott and Associates. We are a comprehensive financial and tax advisory firm. We help our clients to reduce their tax liability, increase their income, and help them grow their net worth. We work with individuals, solo entrepreneurs, and small business owners. Today, we're going to talk about the Sep Ira and the Solo 401k. These two qualified accounts are for the self employed. There are obviously differences between the two. We will cover that. So let's get started. With the Sep Ira eligibility and contribution limits, any businesses with one or more employees which are eligible for the Sep Ira, including freelance workers and independent contractors. This includes self employed people, solo entrepreneurs, LLC, C Corp, and S Corps. Okay. The maximum contribution into a Sep Ira is the lesser of 25% of your adjusted gross earnings or profit, or a maximum of 58,000 for 2021, 61,000 for 2022. Since employee contributions are not allowed, SEP IRAs do not allow a catch-up contribution for people that are 50 or older. Funds paid into the SEP IRA are fully deductible up to the IRS limits, giving the business or self-employed person a dollar for dollar reduction in your taxable income. That's really big. And for side hustle workers who don't pay withholding taxes and worry about their year end tax bill, the deduction can really help reduce your tax liability. Okay. What is a solo 401k? A solo 401k is essentially a 401k plan designed for individuals. The plan may also be referred to as a individual 401k, okay, or a one participant 401k. This tax advantage retirement plan is generally limited to just self-employed individuals, okay? Though spouses who work at least part-time for them may be eligible to contribute to one as well, which would be great. If you ran a small business with only one other employee who was not your spouse, you would not be eligible to save for retirement in a solo 401k plan. Okay? For self-employed people, a solo 401k may offer greater annual contribution limits and bigger tax deductions than a SEP IRA. Okay, depending on your income, the solo 401k plans also allow you to make a post-tax Roth contribution. Okay, solo 401k eligibilities and contribution limits. The solo 401k annual contribution maximum in 2021 is 58,000 and 61,000 in 2022. Unlike the SEP IRA, people age 50 and older can make additional catch-up contributions of up to $6,500 a year to a solo 401k plan, bringing up a potential total to 64,500 for 2021, 67,500 for 2022. Those who choose a solo 401k instead of a SEP IRA, the conventional wisdom regarding the 401k versus the IRA question is that self-employed people should choose the solo 401k because in most cases the potential tax savings are higher. Okay, the primary question many taxpayers ask when deciding between a SEP and a 401k is what's the maximum, okay, I contribute, In most cases, the solo 401k allows for a greater contribution and tax deduction, especially in cases where the individual that's self-employed income is limited, but that's not the only reason to pick a solo 401k. Solo 401ks also offer features more on par with other employer-sponsored retirement plans that a Sep Ira lacks. Okay, you can, for an example, generally take out a loan from your solo 401k plan equal to the lesser of 50,000 or 50% of your account balance. Okay, solo 401ks also offer catch-up contributions for people 50 or older, as well as a Roth option which lets you pay income tax now in exchange for tax-free withdrawals in the future. Okay, in retirement. Who should choose a SEP IRA instead of a 401k? Entrepreneurs who go with a SEP IRA because of potential future hires have another important consideration. Okay, all employees' contributions must be the same percentage of the compensation. For instance, an entrepreneur who wants to put in 10% of their net income into a SEP IRA must also put 10% of the workers' pay into a SEP IRA. Okay? Two, so every situation is different, and the individual should assess the options that is best for you. Okay? There are financial goals that goes in with that. The time for you to enroll in either one of these accounts is prior to you filing your tax return. Once you filed your return, you cannot participate in this account or make contributions to this account. So you have to have this done, okay, before you file your tax returns. That information has to be on your tax return. Okay, so keep that in mind. All right, okay. So for more information on which one would be best for you, please contact me at awelliott at awelliott.associates.com, or you can call me at 909-252-0453, or you can go to our website, which is awelliottassociates.com.